and we're going to separate it out into those that are dealing with the public account, those that are dealing with those that are public companies, as well as those that are dealing with private companies for you to consider. We will also be hosting this again this afternoon for our clients so that they can be thinking about this. So our goal here is to the extent possible, try to make sure that everyone is ready to close the year on a positive note and knows what changes are coming down the pike. So that's it for the introduction. My name is Melissa Galasso. I am a director in the Charlotte office for Cherry Bekaert. And more importantly, with me right now is Michael Hoos. Michael, can you introduce yourself to everyone?
Sure. My name is Michael Hoos. I'm a senior manager in the professional practice department. I'm based out of the Raleigh office. I spend about half my time with client service type things and the other half my time doing training such as this or consultations or pre-issuance and quality reviews. I got a good amount of experience in the SEC and tech and life science and that kind of stuff.
We are so excited to have you with us today to talk about those SEC type clients that I avoid like the plague. And so super excited that you're willing to step in for me and cover those. So today's learning objectives are to be able to list the ASUs that will be effective for our December 2018 year end. So again, focusing in on that concept that this is what we need to know, and then describe the impact these ASUs will have on the financial statement. So let's dive on in here. First off, we need our first code word for Engage You, and that code word is AMLER, A-M-L-E-R, named after the very famous Roy Amler, who is in our PPD department in Charlotte with me. And we wanted to pay homage at the end of the year to some of the very important people. We'll call them our VIPs in the accounting world. And Mr. Amler is getting his shout out first this morning. All right. So again, Amler, A-M-L-E-R. All right, so I'm going to kick it off with those non-public entity items. These are things that are now due. For the most part, public companies have already implemented these standards, and it is our turn in the non-public world to do our part in implementing them. So our first one up is the balance sheet classification of deferred taxes, not debt. Debt is currently actually being dragged through the mud and probably won't even issue this year. But the balance sheet classification of deferred taxes, which dates all the way back to 2015. So we had to dig deep on this one in order to find the original slides that we taught this with when it was issued back in 2015. And basically, GAAP prior to this standard required that we actually separate deferred income tax liabilities and assets between current and non-current. And the great news is no one knows what deferred tax asset or liability is, let alone whether it should be current or non-current. And FASB received feedback that it wasn't really useful because the classification never really aligned with the time period when the actual recognized deferred tax amounts would be expected to be recovered. So that was a long way of saying nobody understood what was going on and there was not a lot of benefit. So in the ASU 2015-17, going forward, they eliminate the classification between current and non-current. And going forward, all deferred tax assets and deferred tax liabilities are going to be classified as non-current in a classified statement of financial position. You do have to remember that there are certain rules related to offsetting that are not being changed. So as you can see here, public business entities did that last year, and now for all other entities, it's our turn with our 2018 year ends. Another one, living in the city of Charlotte, which I like to think of as the city where banks buy other banks, is this concept of novation. And basically what is going on here is there was diversity in practice, typically between accounting firms, as to whether or not when there was a novation, they would require their clients to de-designate the hedge and then reperform the hedge documentation under the new classification. And basically, what is a novation? It is basically when one party is replaced by another party in a derivative instrument. So if you have a swap with Bank A and Bank A is bought by Bank B, you now have a swap with Bank B. And so you would receive a novation letter. Well, some people were saying, well, your documentation for your hedge is out of date. and therefore you have to redo your hedge documentation and all of the relationships with it. Other people were saying the only thing that changed was the counterparty, and therefore we're not going to do anything, leading to some diversity in practice. And so under the new standard, a novation basically is clarified to say, in and of itself, assuming nothing else changed in terms of the terms and conditions, does not require de-designation of the hedging relationship, assuming that everything else related to your hedge accounting criteria continue to be met. So reducing that diversity in practice. Again, this is one that public companies did last year, and it is our turn for private companies to adopt. One of my favorite ones, is related to contingent put and call options in debt instruments. Basically, Topic 815 is one of the most, I would call it, swirly, complicated areas of the codification. And Topic 815 requires that if you have an embedded derivative, you have to actually separate the host contract from the underlying to determine if certain criteria related to derivatives are met. Well, one of those criteria is that the economic characteristics and risks of the embedded derivative is not clearly and closely related to the economic characteristics of the host contract. Now, I am very fortunate to spend most of my time in government and nonprofit, and I avoid this like the plague. But for some reason, one day Michael was not available, and I got put on an awesome SEC client where I had to work through this. And it was probably the most ridiculous set of guidance I have ever read. And it was so difficult that the FASB felt bad for us and created the Derivatives Implementation Group. And they tried to clarify the implementation guidance and created a 4-step decision sequence in order to apply to all call or put options. And it was so nice, and it was so logical and so made sense, except it didn't actually follow the original guidance. And so as a result, questions emerged whether the 4-step decision-making sequence was even permitted because they had simplified it to the point where it no longer followed the original guidance. And so what I love is that FASB said, you know what, we kind of think that this is a good idea. And so what they've done is they did clarify that you can now perform the assessment using just the 4-step decision sequence that the Derivatives Implementation Group created in lieu of having to follow the original crazy guidance that nobody understood. And so this was effective for public business entities last year. Private entities will also have the opportunity to try it out this year. But I am grateful that I don't have to do that all that frequently because, Lord, that was not any fun. And Michael, I appreciate if you would take all of those for me going forward that come to the help desk.
Sounds like a plan.
Good, because I don't like them. I kind of like my lovely clients who never give me those type of items. One that is, I think, a really awesome standard to come out, and I don't do a ton, again, with employee share-based payment, but this is some significant simplifications, is related to ASU 2016-09. And what happens here is there's actually a bunch of different things that are getting updated. So there were some changes related to income taxes and forfeitures. And I'm just going to give you a little high-level overview of some of the impacts. So let's start with forfeitures, because that one's a really interesting one. Current GAAP asks us to figure out and to estimate, basically, the number of awards that are expected to ultimately go through the vesting process. And one of the things that happen, you might get an award that vests, say, in 5 years. And if you leave before 5 years, you forfeit the award. And so basically, we have to estimate the number of options that will eventually be forfeited in order to come up with what makes sense for calculating compensation costs. Well, basically, we really suck at estimating forfeitures because people don't leave they don't leave only based on monetary items. There's other reasons why they might leave and leave an option on the table that is in the money. And so what we have found is that it's very difficult to do, and we're not really good at it. And so one of the things this ASU does is allows for an entity-wide election. So again, this is an option, and you have to make an election. You can either continue to estimate the number of forfeitures. If you really like that method, you can keep it. However, it also allows us to just account for forfeitures and compensation expense or in compensation costs when they occur. So basically what you would do is that when you have someone forfeit, you would reverse any compensation cost that was already recognized in the period where they actually forfeit instead of having to estimate. And so this is basically moving away from the accrual side of it to when does the actual forfeiture happen. So a lot of people really like that aspect of it, makes it a little bit easier for us in terms of adoption. In terms of cash flow, there was no gap directly in there regarding when you had cash paid by an employer to a taxing authority when you were withholding for tax withholding purposes. And so this is kind of an interesting one. So if I am withholding for tax-related purposes and I make a payment to the taxing authority, some people thought it was operating because it was related to compensation. Some people thought it was financing because it was related to issuance of stock, and FASB basically voted and said that if you're making a payment by an employer to a taxing authority related to withholding shares for tax withholding purposes, it would be a financing activity on the statement of cash flow. Most people I talk to find that interesting. They would have leaned towards operating, so you can see where that diversity in practice came from. Another one that is out there is related to what we call the expected term. And basically, when we are doing our valuation, we have to come up with a method for valuing the stock compensation. However, one of the things that you have to take into account when you do your valuation technique is the expected term. And the expected term is the period of time in which the award is expected to be outstanding, assuming that the award vests. So take, for example, you might have an award that has a 5-year vesting and it expires after 10, right? And so when somewhere in that period will be the expected term. And so basically it allows non-public companies a practical expedient to estimate the expected term. And basically the rule is if the vesting is dependent only on service, meaning I just have to work a certain number of years in order to earn it, then the expected term is the midpoint between the requisite service period, the 5 years, and the contractual term of the award, 10. So that would be like 7.5 years. However, if vesting is dependent on satisfying a performance condition, meaning I have to do something, not just work for the period of time, but I have to achieve some performance-related condition, then I have to determine whether the performance condition is probable of being achieved. If it is probable, we're going to go back to that lovely expected term. However, if it's not probable, then if the contractual term, we would use the expected term would be either the contractual term if the service period was implied, or back to the midpoint if the requisite service period was stated explicitly. So that one is, again, making it easier. This is specifically for non-public entities, but it does actually follow something very similar to what public companies do. Another one that gets a lot of discussion, especially for private companies, is related to intrinsic value. So when we originally wrote the rules in this area for compensation related to stock comp, non-public companies actually were given an option to measure liability classified awards at intrinsic value. And the cool thing about intrinsic value, it is basically the difference between the options exercise price and the current market price. So for example, if you had an exercise price of 20 and the current market price was 25, you have an intrinsic value of $5, right? So a little bit easier on the calculation as opposed to fair value. However, it was something you had to opt into. And what we found is a lot of non-public entities were not aware of the option. And given the private company decision-making framework, we know that happens a lot of times because if it's not applicable to public companies, it's less likely to be brought up in discussions. And so what happens is they didn't opt in. And then if they wanted to opt in, they had to do preferability analysis. And so sometimes it's hard to say just because it's easier, it's preferable. And so basically ASU 2016-09 basically allows non-public companies to take that to make that accounting policy election one more time and to move its liability classified awards out of fair value and into intrinsic value without having to do a preferability analysis. So it's just our last ditch option to opt into this. And so again, public companies adopted this standard last year. This is our term for private companies. It is not something you can pick and choose. You have to adopt everything at the same time. But at this point, we are just in the period of adoption. ASU 2016-14 has been done as a standalone webinar 4 times now. So I feel pretty good about the fact that we should be we should be pretty confident about where we are for the standard. But again, this is related to the nonprofit world. So if you have any nonprofit clients, we should be pretty aware of where this is going. So when we think about this, when we look at ASU 2016-14, there are a significant number of changes in here. First off, net asset classification, moving from 3 net asset classes to just 2, net assets with donor restrictions and net assets without donor restrictions, which will be a change on the face of the statement of activities and statement of financial position. In addition, it's going to require that board designations include both the amount and the purpose. So today, about 50% of nonprofits voluntarily provide information about board designations, but half provide no information. So this will be the first time for some nonprofits that they have to disclose the amount and the purpose of those board designations. In terms of investment return, we're going to report investment return net of external and direct internal investment expenses. And so that direct internal investment expense would include things like salaries, benefits, travel. So again, makes people work a little bit for giving an apples to apples comparison. As a result, one of the things that we have is a change in the underwater endowments. So going forward, you're going to present the entire amount of the underwater endowment in net assets with donor restrictions, and then instead of borrowing from today, what we do in the unrestricted column. However, as a result of that, there are new disclosures that in the notes you would have to provide the original amount, the fair value today, and your deficiency as a note disclosure. It does remove from the cash flow statement the requirement to do the indirect reconciliation if you're doing the direct method. That is to encourage more nonprofits to use that option. When we have a contribution of a gift of a long-lived asset, today we have 2 options. We can use either an implied time restriction or we can use a placed in service approach. ASU 2016-14 removes the option to use an implied time restriction, and all entities will be required to use a placed in service approach. One of the bigger undertakings for a lot of nonprofit is actually going to be in the area of functional expenses. So going forward, you will have to report all of your expenses by nature and function in one place for all nonprofits. Today, only voluntary health and welfare organizations are required to do so. So getting that reporting has been a little bit of an implementation issue for some nonprofits. And the one that's getting probably the most attention right now are the liquidity and availability footnotes. So quantitative and qualitative information that explains both the availability of the entity's financial assets, as well as what is the entity's policy and how do they manage their liquid resources to meet cash needs for general expenditures within 1 year of the balance sheet date. And so that was going to be something that has to be written for by scratch. So if you have a nonprofit that has a fiscal year end of December 2018, it will be this December. For those of them who have fiscal year ends in June 30, it will be June 30, 19. So it's still a good time to be talking to clients with June 30, 19 year ends because this is a big undertaking. All right, that leads us to our next code word, which gives homage to Mr. Jonathan Krafchick. So our code word is Krafchick, K-R-A-F-T-C-H-I-C-K, in honor of our wonderful director or managing director of innovation and learning. And I think his title has like 90 things in there, but we're just going to think about Mr. Wonderful Jonathan and all the cool things he does in learning and innovation for the firm. So again, the code word is Krafchick. All right, so that was everything that private companies needed to do. So whether you're a nonprofit or you're a non-public entity, that's pretty much the gamut. However, there are some things that apply to both public and private entities, and that is the area of modification accounting. So this is when one word makes a huge difference for the FASB. So the Master Glossary, when they defined the word modification, defined it as a change, and here's that horrible word, any of the terms or conditions of share-based payment. And so some people were saying, oh, you changed the name of your company, you changed the terms and conditions, oh, that's modification. Well, that's important because modification accounting actually treats the modification as an exchange of the original award for a new award. Well, by doing that, you actually might end up incurring compensation costs for incremental value. That doesn't make sense if you have what we would deem to be an administrative change. And so any was a little bit of an overstatement. So what they decided to do is they said you would default to modification accounting unless all of the following. So you have to have all three of these. The change, there's no change in the fair value of the award before or after the modification, meaning fair value did not change. The vesting conditions before and after the modification are exactly the same. And then the classification of the award is the same before and after, meaning if it was an equity instrument or a liability instrument, that doesn't change as a result of the modification. If none of those happen, where you have no change in fair value, no change in vesting, and no change in classification, then it's not really a modification, and you would not have to follow modification accounting. So this is effective for all entities for this upcoming calendar year. So for those who are dealing with those in public, as well as those who are private, you would be responsible. And it is prospectively to an award modified on or after the date of adoption. All right. So our next code word here is golden, and this one is an homage to Mr. Russ Goldman, who is the chair of the FASB, so the Financial Accounting Standards Board up in Norwalk, Connecticut. Mr. Golden is our very illustrious chair right now, coming with a very interesting background. His wife's also a kick-ass female, so we like her as well. And so the two of them together are a nice little power couple. And so we are very excited to celebrate both Mr. and Mrs. Golden today, so Golden, Golden. All right, with that, I am done with our non-public entities. I'm going to turn it over to Michael to handle our public business entities.
Thank you, Melissa. So these next few ASUs are going to be effective for public business entities this coming busy season for fiscal years generally ending in 12/31/18. But also it's something important to take note if you have a private company, because generally private companies end up having to adopt these standards a year later. So these are things to talk about your clients with your clients now. So with that, the first one is ASU 2016-01, the recognition and measurement of financial assets and financial liabilities. And what this update does is it creates a new codification section, ASC 321, investments in equity securities, and it renames codification 320 to investments in debt securities. Now, there's not really any change in debt security accounting per se. It really, the change is in equity securities, and you'll no longer classify those equity securities as available for sale or trading. Instead, all unrealized gains or losses will run through net income. Now, these equity securities do not include equity securities that are accounted for under consolidation or equity method guidance. That those gains and losses will remain the same under legacy GAAP. It does create a new OCI item, other comprehensive income, if there's a instrument-specific credit risk, and you're using the fair value option, and this is only applicable if you're using the fair value option, the entity-specific credit risk, and that could be, looked at as the difference between the change in fair value of an instrument versus the change in risk-free rate. If there's an entity-specific credit risk, that should be separately stated on the OCI, other comprehensive income. And that's kind of a big change because previously all the changes would run 100% through net income, which kind of created a counterintuitive situation where if your credit risk declined, then your financial statements looked a little bit better because it ran through the net income. And so what the FASB's done is they've basically said that if it's entity-specific credit risk, it needs to run through OCI, and when you de-recognize a liability, that will result in the reclassification from accumulated other comprehensive income to net income. And so that's pretty much the changes in this ASU, and this ASU is effective for public business entities for fiscal years beginning after December 15th, 2017. So essentially for calendar year ends this December 31st, 2018. And for all other entities, as I said, they generally get a year later to do this. And so it's for fiscal years beginning after December 15th, 2018. So it will be applicable for the December 31st, 2019 calendar year end entity. So might be something to talk with your client about now. The next ASU is ASU 2016-04, and that deals with the recognition of breakage for certain prepaid stored value products. Another way of putting it is just, gift cards. And the gift card industry is booming, let's say that. I think it is over $500 billion now. So this is something that, is likely to affect some of our clients. And this ASU, what it does is it deals with breakage. And what is breakage? Well, breakage is the methodology that is used to recognize a portion of the dollar value that will never be redeemed. So, we all get gift cards, and then sometimes we drop the ball a little bit, and we don't use them, we forget them, we lose them, that kind of thing, and that's called breakage. And so what this ASU does is it kind of eliminates diversity in practice and confusion. So prepaid gift cards are a financial liability to the issuing entity, right? I have to give you a good or service when the recipient of that gift card comes in. And financial liabilities are actually governed by ASC 450-20, and that deals with the sale, transfer, or derecognition of financial liabilities. And so there was some confusion in practice because, you see, ASC 450-20, that allows you to derecognize a liability only if it's been extinguished, and extinguishment meaning like delivery of cash or some other asset or the goods or services being, legally released by a creditor or judicially. And so prepaid gift card breakage doesn't really fit into that. And so what happened is that you have some issuers that had this, growing liability balance because they thought 405-20 was the applicable codification. And so what this does is it clarifies that no, when you're selling a gift card, use 606, which allows you to factor breakage into there. So if I have a $100 gift card and I think that 20% of my gift cards are not going to be redeemed, then I really only have an $80 liability. And so what that ends up doing is it allows you to, as someone uses that gift card, you proportionately reduce that gift card for that $20 that you expect are never going to occur. Or you get to release that liability when the gift card is expired, or if the chances of it becomes remote, 5 years later, who's really going to redeem that gift card? And this ASU is effective for public business entities for fiscal years beginning after December 15th, 2018. So no surprise, for December 31st, 2018, it's effective now. And then again, most entities get an extra, private entities get an extra year. And so it'll be effective for your private entities for fiscal years beginning after December 15th, 2018. So your 2019 fiscal year. So something that you might want to talk about with your clients. The next ASU is ASU 2016-15, and that deals with the classification of certain cash receipts and cash payments on the cash flow statement. So the cash flow guidance is principles-based, and so that inevitably leads to confusion and diversity in practice. And so what this update does is it clarifies some things, and there's a number of things it clarifies. The first one being debt prepayment or debt extinguishment cost. And what it says is that those are financing. They should be classified as financing on the cash flow statement. And then the next one is settlement of zero coupon debt. And so that's kind of a split between operating and financing. So if it's a principal repayment, it would be financing. If it's a non-principal payment, it would be operating. So you would split the payment between financing and operating in that way. The next one is contingent consideration in a business combination. And so many times in a business combination, there'll be some sort of maybe the buyer and the seller don't necessarily agree on the fair value, so they'll have some sort of like oftentimes like called an earn-out or something that's, there'll be a payment if, earnings reaches a certain level or revenue reaches a certain level over the next, year or several years, that kind of thing. So that's a contingent consideration. And there was some, diversity in practice as to what that should be classified as when we pay those contingent considerations. And what it says is that if the contingent consideration is paid soon after the business combination, so, roughly 3 months or less, then it should be classified as investing. If it's past that point in time, then it depends on, what you classify the payment portion going to. So, for example, if your payment is going towards the initial fair value plus any measurement period adjustment, then you would have it classified as financing, right? So you get a year after a business combination to adjust the numbers. And so if it is the initial fair value plus any of those measurement period adjustments over the year that you have, then it would be financing. But let's say that the contingent payment's paid, 3 years later, and there's other adjustments to that contingent consideration. You're marking it to fair value every period. The portion of the payment that's to contingent consideration that's above and beyond that initial fair value and any measurement period adjustment, that would be classified as operating. And then the next one is proceeds from insurance, all right? So sometimes, you'll have a fire or there'll be a natural disaster or something like that, and you'll get insurance proceeds. And what this says is that you should base it on the nature of the loss, right? And so if the nature of the loss is like a business interruption, then it would probably be operating. If it's more of, a piece of property, it might be more investing. And so the more complicated thing is when you have a lump sum. You get it covers multiple things like the loss of a building and business interruption insurance. And then you would have to determine, you would have to split it up and classify it accordingly is what it says. And so those are the main changes, but there's also several other more niche changes. For example, proceeds from corporate-owned life insurance. That would be classified as investing. And then distributions from equity method investees, okay? So you have an equity method investee, meaning you probably own maybe, 25, 30%, something less than controlling, but something greater than 20%. And what this ASU does is it basically says that you have a choice. You can apply either kind of a cumulative earnings approach or a nature of the distribution approach. And so if it's a return of the investment, meaning like I've invested $100,000 and it's grown and now I'm being returned that original $100,000, then it should be investing. But if you're being returned on the investment, so I contributed $100,000 and they earned my portion of their earnings this year is $50,000 and they are giving me back $50,000, then it would be operating. So it's kind of the nature of the return is the option there. And then the next one is beneficial interest in securitized transactions, and the receipts would be classified as investing. And then the last thing that it kind of changes is or solidifies is the predominance principle. And what the predominance principle says is that first you apply any kind of explicit guidance in 230. So if 230, which is the ASU that governs cash flow statements, if it says this is how you should account for a specific receipt or payment and classify it in the cash flow statement, then you apply that. Then if it doesn't give specific guidance, you determine each separately identifiable source and classify it accordingly. But third, if the receipt or payment has aspects of more than one source, so you get a payment and you're like, well, this kind of has aspects of operating and it kind of has aspects of financing and maybe even investing, then you determine what the predominant source or use of that cash is, and that's the classification that you would give. And so that ASU is effective for public business entities for fiscal years beginning after December 15th, 2017. So in other words, it's applicable for this 2018 calendar year-end busy season. And for all other entities, you get a year reprieve. And so, again, this might be something to talk to your private entity clients about. The next ASU is ASU 2016-16, and that deals with inter-entity transfers of assets other than inventory. And so what this does is it eliminates an exception for an inter-entity transfer of an asset other than inventory. That probably doesn't make a whole lot of sense to everyone, so let me kind of explain. ASC 740 income taxes, that deals with your income tax expense or benefit, your DTL or DTA, and it prohibited the immediate recognition of the tax effects. That means whether it's a tax expense, benefit, DTL, DTA, it said you could not recognize the tax effects of an intra-entity transaction. For example, if I have an inter-entity transfer of inventory, or maybe an inter-entity transfer of IP from one subsidiary to another. And what this basically says is that other than inventory, and they kept inventory from immediate recognition because the board felt that was a little too burdensome. What this does is it says, okay, if you have, say, for example, a transfer of intellectual property, you can immediately recognize those tax effects, because otherwise it creates kind of a bookkeeping nightmare to wait until that actual IP is, say, sold to a third party or somehow generates revenue that would otherwise be taxable. You don't have to wait to recognize that inter-entity transaction from a tax perspective. And this ASU is effective for public business entities for this coming 12/31/18 calendar year-end audit. And for private entities, it is effective for next year's audit, the 12/31/19 audit. And early adoption is permitted. The next ASU is ASU 2016-18, and that is another one that deals with the cash flow statement. We got a number of them that deal with the cash flow statement here. And this one deals with restricted cash and how restricted cash is presented on the cash flow statement. So what this update does is that it says that the statement of cash flows can explain the change during the period in total cash, cash equivalents, and amounts generally described as restricted cash or restricted cash equivalents. So what happened is that there was diversity in practice because some felt that restricted cash would be, changes in restricted cash would be either operating, financing, or investing activity, and not the actual, would not be treated like normal cash or cash equivalents on the balance sheet. So as you all know, on a cash flow statement, you reconcile your net income to the change in cash and cash equivalents. And what this basically says is, okay, when you're doing that, you need to consider restricted cash as cash and cash equivalents, meaning your restricted cash shouldn't be somewhere in operating, financing, or investing. What it should be is it should be on that bottom line number, and everything above it is explaining the changes in both your normal cash and cash equivalents and your restricted cash. So it's not going to be in the cash flow statement directly. It's going to be in that total that you're explaining the change in. And then it also changes some presentation and disclosure items. So when cash, cash equivalents, and restricted cash are presented in more than one line item on the balance sheet, the new guidance requires a reconciliation of the totals in the statement of cash flows to the related captions in the balance sheet. So let's say we explain a cash a change of $100,000, and on the balance sheet we have cash of one amount and a restricted cash of another amount. What this basically does is it says on that cash flow statement you need to show, or on the cash flow statement or in the notes to the financial statements, you need to show how that change in cash that you just explained what portion of it relates to general cash and cash equivalents, and what portion of it relates to restricted cash. And this ASU is effective for public business entities for this coming December 31st, 2018 audit, and for all other entities, private entities, it would be effective for the December 31st, 2019 calendar year-end audits. And so again, it's another thing to think about to talk with your company, your client, if they are a private business. So the next ASU is ASU 2017-01, and it deals with clarifying the definition of a business. And I think that this is a very big ASU because from my experience, way too many transactions were treated as a business combination or a sell of the business. And so I want to kind of back up before I go into the the details of this update and say, why it's important. So if something is a business and you sell it and it qualifies as a business from an accounting perspective, that means that you're required to apply fair value measurement accounting, which means you generally have to go out and get an expensive third-party valuation. And then you also have to identify unrecorded intangibles. It could result in goodwill or a bargain purchase. Whereas if it's not considered a business and you're just buying or selling an asset, say, then there's no fair value that's recorded. You really just record things at what you paid or received for, and you don't have to record intangibles, goodwill or bargain purchase. Transaction costs are capitalized, whereas if it's a business combination, they're expensed. There's a lot of benefits to things not being a business combination. And prior to this ASU, a business from an accounting perspective was anything that included an input and a process. And if you didn't have all of the processes necessary to take that input and create an output, then you still could have a business, because if the buyer could go out and get a process in the market, then you would have a business. And so that means that things such as like a drug compound, I'm buying a drug compound, say, for example, that would be considered a business potentially, because the input, which is the intellectual property, is there. And the process, and again, you have to have an input and a process under the legacy gap, that process, maybe you're not selling a process, you're just selling the drug compound, but a third party could go to a CMO, a contract manufacturing organization, and they could purchase. They could say, hey, take this drug compound, this intellectual property, and make me the actual pills, and then that would be considered a business. And what this ASU does is it says that's kind of nonsensical, and it basically says it provides a screen that you first use to determine if something's a business, and that screen is that the entity has to determine whether substantially all of the value of the gross assets acquired is concentrated in a single identifiable asset or a group of similar identifiable assets. And it gives a little bit of guidance on what exactly that means. When I have, say, a building and leases in place and that kind of thing, or, what is similarly identifiable, there's some details in there. But the thing is like if I sell just let's go back to my example of a drug compound, that's if I'm only selling that, then that's a single identifiable asset, or maybe I'm selling a couple drug compounds. It's a group of similar identifiable assets. So then I wouldn't have to apply, this complex and expensive business combination accounting. I could simply just account for it as though I bought a computer or a desk, like any other fixed asset, so to speak. Now, if that screen is not met, okay, then in order to be a business, a set of assets and stuff that you purchase has to include, at a minimum, so that means it's not going out to the market and getting, it means the actual buying and selling includes, at a minimum, an input and a substantive process that typically that together will significantly contribute to the ability to create an output. So in other words, you have to have a process included in that purchase, and that process has to be substantive, and it has to substantially contribute to creating an output, right? And so now that this idea of, well, I can get pretty much any process I want outside in the market, then that made it so that most things were a business combination. That goes away, and now you actually have to buy a process as part of the transaction. And this ASU is effective for public business entities for annual periods beginning after December 15, 2017, so this 2018 calendar year end. For all other entities, it is, again, you get a year reprieve, and so it's going to be effective for calendar year ends December 31st, 2019. So it's definitely something to discuss with your clients about this, because it's definitely something that is going to be very positive, and it's a good move that the FASB is doing in this, and generally in the simplification and such. So the next ASU is ASU 2017-05, and it deals with clarifying the scope of asset derecognition guidance and accounting for partial sales of non-financial assets. This ASU's got a lot of details in it and nuances and such. That's a little bit beyond the scope of this webinar, but the general impacts here are, ASC 61020 was created by 606, and it dealt with recognizing other income or gains or losses from non-financial assets. So non-financial asset would be something like a PP&E or an intangible, that kind of thing. And there was some confusion and diversity in practice, because ASC 61020 appeared to only be applicable to non-financial assets within the scope of 350, which was intangibles, or 360 PP&E. And the amendments clarify that 61020 applies to all non-financial assets, not just those that are within the scope of 350 or 360. If the sale is to a customer, then you would apply 606. And if the item being sold is a business, then you would apply ASC 18, the consolidation. And so when you're determining whether the transaction involves a business, entities would apply the new definition of a business that I just mentioned. And so this ASU basically kind of creates a two-step process. You first ask yourself, does the seller have controlling financial interest in the buyer? If yes, then you don't recognize, you treat it as an equity transaction. That makes sense, right? We don't want to play games and sell something to a subsidiary, that kind of thing. But then step two gets into more substantive, and it says, does the contract exist under 606? Meaning, did you meet the thresholds to form a contract under 606? And did the buyer obtain control of this non-financial asset? And if yes, to both of those, then you derecognize the asset and you recognize it in accordance with the revenue in accordance with 606. If, say, that the contract exists but the control didn't transfer, then you would go ahead and treat any consideration received in accordance with 606. So you'd probably have a liability on the books until control is transferred. And so the full gain or loss recognized when you derecognize a liability would then be recognized. And this also clarifies the definition of a in-substance non-financial asset. And so an in-substance non-financial asset is it could be a financial asset that is promised to a counterparty in a contract, but substantially all of the fair value of the asset promised in the contract is concentrated in a non-financial asset. So let me give you an example here. So a non-financial asset would be like real estate and maybe the related operating leases that are in place. So that's a non-financial asset. And then there's also, say, a financial asset, a lease receivable, I have a piece of paper that I can exchange for money. It's a receivable. In those situations, there was some confusion where folks said, well, the lease receivable is a financial asset, so I got to account for that under different guidance. But then let's say the real estate and operating leases that are in place that I'm buying, are non-financial assets, so that would be a different piece of guidance. What this ASU says is, look, if most of the value is in that non-financial asset, for example, the real estate and operating leases that I buy when I buy a building, then I can treat the lease receivables that, though technically might be considered a financial asset, I can treat those as an in-substance non-financial asset and account for them as a package. And so this ASU is effective for public business entities with calendar year ends December 31st, 2018. And then again, all private entities will get a 1-year reprieve, and so it'll be effective for calendar year-end private entities that are December 31st, 2019. So it might be, again, something that you want to talk with your private clients about. The next ASU is ASU 2017-07, and it deals with improving the presentation of net periodic pension cost and net periodic post-retirement cost. And what it basically says is it impacts three different things. The location of service costs in your net periodic pension cost. Employers will present the service cost component in the same income statement line item or items as other employee compensation costs. So, maybe SG&A, or if some of it is in cost of goods sold, that kind of thing, wherever the employee would be classified. The location of other components employers will present the location of the other changes in your net periodic pension cost, separately on line items that includes like service costs and outstanding any subtotal of operating income. So in other words, you don't want it to be part of operating income. You want it to be below that, something like, gain or sell of property, plant, and equipment. That's usually underneath operating income, that kind of thing. And so that's where you would present the change in your net periodic pension cost that related to other components. And then it also dealt with the capitalization rules. Only the service cost component is eligible for capitalization and assets. So, for example, your service cost, a component of your net periodic pension cost, that might be something that can flow into inventory and then come out in cost of goods sold. But the other components that make up that net periodic pension cost, that cannot be capitalized. They have to be presented, again, outside of operating income. And this ASU is effective for public business entities for a calendar year end December 31st, 2018, and 1 year reprieve for private business entities. So it would be effective for them for those calendar year ends December 31st, 2019. The next ASU is ASU 2017-10, and it deals with determining the customer of an operation services contract. And so let me kind of maybe do this through an example, okay? So if I am, let's say I am a government and I contract with a third-party service company that will maintain my toll roads. Okay, so the question became well, who's my customer, right? Like under 606, we gotta account for something under 606 if it's a customer. And so is my customer the drivers that come through the toll road, or is it the government who's paying me to manage their toll roads? And what this clarifies is it says, look, the grantor, in this case, the government, not the drivers, would be the customer. So the grantor in a service concession arrangement would be the customer. And so that's a good clarification because it lets you know what scope, what topic to use. And this ASU is effective for if you have not adopted 606, then for an entity that has not adopted 606, it would be effective before the issuance of this update. If you've already adopted 606, it would be effective for those fiscal years beginning after December 15th, 2017 or 2018 year ends. And then for all other business entities, you get a year reprieve, so it would be effective for your December 31st, 2019 year end. And with that, we have the revenue recognition stuff. There's a lot on here, right? All I want to make everyone aware is that, essentially 606, one of the biggest changes we've had in a long time in accounting, that is effective for public business entities for December 31st, 2018 year end. And because public entities have quarters, they've all pretty much adopted that. For December 31st, 2019, that is the effective date for private entities, and it's not going to get pushed back. It's highly unlikely that's going to happen. And so just be aware of that. And that leads us to a poll question, I believe. Is that correct, Melissa?
Yeah, I'll take it from here. As a reminder, for those of you who are interested in learning more about RevRec, we will be replaying all 8 webinars in January and February for replays, so you'll have an opportunity to get a refresh on each of the 5 steps, as well as industry-specific guidance, disclosures, and transition. We will be replaying all of those webinars as live webinars, so you can get CPE for them. So that's something to be on the lookout for. So our last code word is right. I was not going to have 4 guys as our homage, and so this one is an homage of Miss Candy Wright, who is the chair of the Private Company Council, or PCC, one of my favorite ladies in accounting, and she is a rock star, and so we are going to pay homage to Mrs. Candy Wright. So W-R-I-G-H-T. That is a lot to take in a 50-minute webinar, and so we appreciate that. However, we do want you to take a look at this list here. These are other items that you might want to consider talking to your clients about. They are not effective yet. However, they would make for great early adoption. Many of them are simplification, like the goodwill one, like the hedging one, which makes things easier and better. The one related to cloud computing is of particular interest if you have clients who are in that process. So I would totally recommend that you take a review of these as well as part of that process. We will cover the 2018 ones in our ASUs issued in January webinar, but otherwise we would just recommend that you review these and take a look to see if they'll help your clients. With that, I want to thank you guys so much for joining us. Thank you, Michael, for walking us through this very difficult public company section. And we want to wish you all a very happy holidays, and we will see you in 2019 with ASUs issued. Have a great day, guys. Bye-bye.